Hey everybody, it's Pete Carmesino here at Chaikin Analytics. This is the halftime show on StockCharts TV. Sorry, we had some technical difficulties. This was supposed to come out yesterday, but I'm going to redo it today, and it's going to be just as good, if not better. So, what I was talking about, or what I wanted to talk about, was just some comments on the banking sector. What Jamie Dimon was talking about just a few days ago about new regulations coming out, and his, you know, sort of pushback on the regulators, for asking banks to set aside more capital. Now, look, I understand that as a banker, no one wants to do that. Obviously, you can go out and take risk on that money, and obviously take a calculated risk. The bank would like to do that. So I'm just going to go over a few things. Now, I worked inside several banks as an investment management professional, both on the investment banking side and even on the commercial banking side. So, I understand a little bit of how the banks kind of operate. Obviously, not that difficult, really, of a scene. But the story is that, just think of it this way: from a banking standpoint and from a borrower standpoint, on both sides of the equation, there is risk, and risk is really the willingness and the ability, right, to take that risk or to give or to lend, right? Each side is taking a risk. Let's look at the bank side first. Obviously, they're a fractional banking system. The more they have to set aside for regulators to be satisfied with the amount of capital they have to cover their already existing risks, which some at this particular point may consider deposits risk because they are liabilities, and the rates are so high now, and maybe that's why the regulators are doing it. I'm not siding with the regulators, I can tell you that. But on the flip side, I can see where that might start to creep up, as started to happen there back in March. We saw a few banks fail because of the way their instruments are being marked in the market. So the issue now comes from the banking side. Is obviously they want to take the risk, but what do they need to be paid for that risk? Rates are already very high. Are those risks that they're taking, are they 5% risks that they're charging 8% for? I don't know, but they've got to have the willingness to take that risk. And if there are good borrowers that are coming to the bank, whatever the case may be, it could be individual, it could be a giant corporation, enterprise, whatever it is, they want to be able to assess that risk properly, which they always do, typically. Now, do they have the ability? So if they have the willingness and not the ability, they're kind of stuck. They can't make those loans. The flip side, think of it from the entity standpoint, the person coming in, the corporation coming in, whoever it is that we're talking about, whatever the case may be, that person also has to have the willingness to borrow at that rate. So if they're willing to borrow at a 7, 8, 9, 10% rate, whatever the rate is, that means the venture that they're going to deploy that capital into has to return a few times that, really, to really start to think about the risk. So they not only have to have the willingness to take a risk at 9, 10%, 12%, whatever it is, they have to have the ability to go get a return on that capital and to be able to pay the loan. And so there's sort of a bifurcation there. If it's not meeting and the demand is dwindling because of the interest rates, well, the banking regulators are pulling in more capital from the banks now. So I can understand, you have to understand that push and pull in the banking sector. So that's why I want to go over the two ETFs that kind of represent it. The one is the regional banking ETF, KRE. The other one is the KRB, just the banking sector in general. And I'll even look at the XLF, but I'm also going to look at one particular sector, which is insurance, KIE, that's breaking out. So we're going to look at that. We're going to look at, our usual suspects. So I'm going to take a look at some the business cycle, the Fed funds rate, over the unemployment rate, kind of looking and trying to dissect what's happening there to see if there's any clues about what the Fed may do next. We saw CPI come out this morning. That was, a muted response, first down on the markets, then up. Not exactly sure what the sort of take is or the takeaway is. It seems to me that it's higher for longer if inflation crept up a little bit, depending upon how you really dissect CPI. And then I'm also going to look at the equal weighted consumer discretionary over consumer staples, and definitely going to look at one stock that has been the darling of 2023. I bet you already know what it is just because I said that word, darling. It's Nvidia. And just a special review of what's kind of happening on that chart from a technical perspective. So let's dive into these charts and take a look at what's happening. All right, folks, here we are. just as a reminder, look, I'm on Twitter. I put out some interesting things. Chaikin Analytics tweets some interesting things as well. So follow both of us here so you can see kind of the conversations we're having here on X or Twitter. Now, we talk about some names that come out like BUD. I brought up the home builder, DHI, because I saw a negative relative strength change here. That was around 116 and change just a few days ago. And that kind of leads me to what I was talking about here in the banking sector. Dr. Horton, DR Horton is still trending lower. It's about 114 now. But we're talking about lending standards, right? And what's happening is the lending standards are being tightened. There's no doubt about it, right? Look, this is the National Association of Home Builders. Okay, this is, they're telling you that the Senior Loan Officer Opinion Survey, the SLOOS, nice acronym right there, fun to say as well, came out for the second quarter. The banking lending activity really tightened across all residential and all commercial real estate loan categories. So what do you have? You've got you're being squeezed from the banking side, right? So they're tightening their standards. Now the regulators are asking for more money. You can expect that Jamie Dimon's unhappy, right? You can go to the Board of Governors, the Federal Reserve System, and read the same information here. July 23, Senior Loan Opinion Survey, the SLOOS, addressed changes in the standards and terms and demand for bank loans to businesses and households over the past 3 months, right? So the point is that things are tightening up just ever so slightly, but enough to really kind of dampen the economic growth aspect of things. And so this is all kind of leading to something that I've been talking about now for several times. I'm going to make this chart a little bit bigger so it's on the full screen. And all this is coming from the St. Louis Fed website. I've got the unemployment rate over the Fed funds rate. And I say over, it's just two charts on top of each other, okay? And I'm going back, this is 1965, really 1960 all the way back here. And I'm just showing you something that's really is always a trigger. You see the Fed funds rate rising here, right? And you see unemployment rolling over, right? Meaning that more people are working. Now, when the unemployment rate starts to increase, less people are working. And the reaction is that the Fed cuts. Here it is again in 1980. The Fed raising rates, they weren't sure, they raised them again. And what happened? Unemployment rose, they dropped it. They came out too soon. What happened again? Unemployment trended lower, which is great. I mean, more people work. And then all of a sudden, it spiked up again in 1981. What do they have to do? Lowered rates again. Now the unemployment rate falls all the way, for about 8 or 9 years, almost 10 years. And it happens yet again. Do you see a pattern? It's never not happened, meaning that when the unemployment rate starts to tick higher, and I don't know what the metrics are specifically. In other words, what rate of level of unemployment has to be the trigger. The Fed's going to tweak that depending upon the environment. All of these environments are different, but here we are again. Do you see the pattern? Let me squeeze this chart in a little bit further so we can get a better view of this year, right? Here we are. We raised rates, paused, unemployment went up, brought the rates down, right? This was the great financial crisis, all the way down to here. What did we do? We raised rates. Remember, we had this happening in end of 2018. They paused. Unemployment came out. We had COVID. The whole thing kind of got a little wacky, and they had to drop rates, in a fast manner. What happened again? Unemployment came all the way back down to previous levels, and rates are up. So, is the next move going to repeat itself? I'm just saying that it's never not happened. My point is that just pay attention to this relationship and be prepared when this starts to happen. Understand what you're seeing before it happens. Okay, now I'm going to paraphrase Jamie Dimon here in his comments that he made. I believe they were published in a Reuters article. I'll try to find the article while I'm talking here. But the point of me bringing this up is that Jamie Dimon himself. Now, this is really he's the face of banking, so to speak, in the the 21st century now. This is really what he's saying. He's saying he wouldn't be a buyer of a bank. And let's look at regionals first. Actually, look at KBE first. KBE here. Well, then we'll look at regionals last. The banking sector has been in a downtrend. I mean, for me, I've been struggling with this sector, trying to figure out why. Right, when rates are rising, we thought all things were going to be leading to financials, flying high. Now, J.P. Morgan, a lot of banks did really well, but in general, the index has not done well. Here, you've had the crisis, right, when that started in March. Obviously, that was put a dampening effect, on this particular segment of the market. If I look at regionals, KRE, right? These are both the Spider S&P Regional Banking Index, and the other one was the Banking Index. Again, another a Spider S&P Index. Same setup here. I haven't seen an idea that looked good really since October of 2020 when the financial started to move higher, right? And that's when we try to find these trends. And here we are. This trend is negative. I agree with Mr. Dimon. I would not be a buyer of banks. Not yet. Certainly not yet. And I'll look at XLF since we're talking about sectors. This is a financial sector. Now, this has a different makeup, different weightings than the indexes, the other ETFs we looked at. But still, it's a stagnant looking sector, definitely in a downtrend relation when you put it in, with the relationship to the S&P 500, right? So that sector is underperforming the general market, and it's out of its lower range. This is a downward range, and it came below it and hasn't really recovered yet. So again, I agree. Banking is at this point is an avoid. Leads me to my next spider sector here, the insurance ETF, KIE. You can see the symbol right here, KIE. And this one actually is kind of interesting. Now, it's not on the ratio. It doesn't look like it's doing much here when you look at the longer term ratio, but it bottomed, based, moved higher, sold off, and now actually looking at another trend moving higher. And you got that 50-day moving up pretty sharply on the ratio, but on the actual ETF itself, it's actually doing very well. So if it can get above this 43.5 level and maybe take out some new highs, this could start to move a little higher. When you look at on the Chaikin system, I've got one of my, I would say favorite indicators here, just starting. Definitely something you want to put on the watch list, but this sector itself is starting to look interesting because it's got a relative strength change on the ETF. So that takes me to diving inside of the ETF and kind of looking at some of the names that are in here that maybe, I don't know, if some of them are changing trend. And voila, look at the first one I'm looking at here is AIG, an oldie but a goodie, also changing trend on the upside. Let's look at Chubb, just starting to change trend. Let's look at, this is Cincinnati Financial. Yep, Cincinnati Financial, not there yet. So not every one of them are looking good, but overall, the ETF is looking interesting, and some of the names inside of the ETF are looking good too. Okay, looking at the equal weighted consumer discretionary ratio to the equal weighted consumer staples. Okay, I drew this parabola here with a little trend line. It's kind of my cup and handle. I thought it came out pretty good. It's hard to work with this parabola a little bit. You got to get used to working with it. But once you get the hang of it, I make them all the time. So looking at this breakout, right? I want to see if this can get above. This is a ratio chart, so it's kind of got a funky level here. You see like 1.39. What does that mean? It's just one divided by the other. Okay, that's all it is. But it gives you a relationship, right? So when this is moving down, that meant that discretionary was being sold or doing worse than staples. Doesn't mean it's an absolute return in staples, but in this case it was. Point being is once that started to bottom and move higher, look where it bottomed. We talk about this all the time, right? End of 2022, really bottomed back in June and then started to base and then break out. And then it formed this pattern here that I just picked up, mentally and visually. I see it. So I drew it on here. And I'm thinking it might, be something to watch if it can break out. But this is just still telling us, still saying that the consumer discretionary sector is doing better on an equal weighted basis than the consumer staples at this point. Okay, I wanted to call out 3 ETFs here that I also saw had some interesting changes in trend. This one's the Invesco small cap, but it's a small cap momentum ETF. Okay, so obviously you're going to see some names that are a little bit more, aggressively moving directionally to the momentum side. But the ETF itself, XSMO, is actually having a trend change, just like KIE. You're seeing the same kind of thing. And here are some of the names. Go look at this. Pull this ETF up and start to look at some of the names here. It could be an interesting fishing pond to start looking for some names. Some of these have already broken out. Some are just starting. Some are up pretty big, right? So these have been trending already. And so you're going to see a mixed bag in there. But the ETF itself I thought was interesting was XSMO, again, Invesco Small Cap Momentum. The next one's going to surprise you. It's the ARKF, the Innovation Fintech Innovation Fund by ARK. Now, ARK has had, a tremendous history here in the last 6-7 years or so of being sort of the boom and bust and moving higher and then getting, broken down after rates started to rise. But all in all, this is starting to change trend just a little bit, and it's in Fintech Innovation Fund. Interesting name to look at. And the next one may really surprise you. It's the ARK Innovation ETF, the generally, innovation ETF. And I go look at this 5-year, you can see where it was and how far it came down. It got all the way up to about 160 or so and came all the way down to about 28 or so, $30 a share. Now it's based and moving higher. It's a kind of an interesting chart. It's not a normal basing chart, but you see a good amount of months here that are basing, and it's just starting to change trend, although it's selling off today. I just think it's something you want to put on your watch list. It's very interesting, although I don't think it's fully cooked at the moment. All right. This is the Nvidia sort of special review. Nothing, out of the ordinary here from a growth name, right? I see a channel where it formed all the way back, again, from that October low. We talk about that. That's been the recent low of the market. And really things have been powering forward since then. You can see where the trend line changed. And how about this trend line? This is a 70 simple moving average trend line. It's been holding, right? It's been literally living on that channel, got above it a little bit, got away from it. But what I drew here were 4 gaps that NVIDIA potentially could fill. The first one's very interesting to me because it really could coincide with the channel check here. In other words, if it comes back and checks back to this channel and then moves higher, it's also filling a gap, which is kind of interesting to me. The issue is if it doesn't hold and breaks down, I don't know if this is going to happen, but the next gap is pretty big and takes it all the way down to about 305 or so, 306. So just something to be aware of. The other 2 gaps at this point are sort of not that meaningful unless these other 2 are filled. And then how this reacts to these levels could be different, but we'll have to see. Again, first one's here right around that 438, we'll call it 433, which would still be a significant pullback from trading from 500, but it could just fill and hold. Let's see how it plays out in the next several weeks. All right, folks, there you have it. That's our show for today. Thanks for tuning in. So I think I gave you about 6 or 7 ETFs, 1 stock review today, having been Nvidia, but a lot of interesting names, interesting things to look at. I hope that this helps. And please tune in again. Leave some feedback here on the YouTube channel, but please follow me on Twitter as well and give me some feedback when you can there. Take care. We'll be back next week. Thanks.